So, continuing our discussion on the swap between A and B, where it was for B was disadvantageous by 1.2 in the fixed rate and disadvantageous 0.7 in the floating rate. So, we want to basically convert their respective position from a floating to a fixed and fixed to a floating. So, considering that A and B get in touch together with a FI, A agrees to pay 4% to the outside agency and A agrees to pay LIBOR to the FI and A agrees to get 3.93 from the FI. Now, A and B are not transacting themselves, they are trying to basically transact with the help of a FI. So, what happens? Let us see. Now, considering from the point of view of the other party. So, if you have considered A and B, so they are the same thing, only the plus and minus based on which how you are trying to analyze would be different. So, it is like this is A, this is B and there is an FI in between. So, you are trying to consider the transactions one at a time. First case, second case. So, this would be case 1, case 2 combined together is when you have the FI A and B, and later on we will see that technically even though we skipped it, but it is very obvious actually A and B initially they were here, next case they came here A and B with a third party. So, this was A, this was B, this was A, this was B, and once this is done you will come to this. So, the actual flow becomes A and B only, then A, B along with their respective third parties, then A and B with their respective third parties along with an FI. So, it is basically stage by stage as we move. So, here B agrees to pay LIBOR plus 1%, B agrees to pay 3.97 to the FI and B agrees to get LIBOR from the FI. So, obviously, if you consider this transaction, you just place them in the top of the arrow and get to understand what is the overall flow happening between A to FI, B to FI or A to the third party and B to the third party. Now, consider the case of only the FI. So, FI is in between. So, obviously, there are four arrows, 2 going outside, 2 coming inside. So, FI agrees to pay 3.93 to A, FI agrees to get LIBOR, FI agrees to pay LIBOR, 2 parties A and B respectively as written in point number 2 and point number 3, and FI agrees to get 3.97 from B. So, if you consider the overall transaction for FI, this LIBOR will cancel and this 3.97 minus 3.93 is basically 0.04. So, this is 0.04 which is the profit for FI is being shared equally to the quantum of 0.02 by A and 0.02 by B. If you basically draw the diagram at the end of the result, you will find out that is the case. Now, we are coming to the interest of currency. Companies X wishes to borrow US dollars as a fixed interest rate, company Y wishes to borrow Japanese yen at a fixed interest rate. The amounts required by the companies are roughly the same and the current exchange rate. The companies have been quoted the following interest rates. So, basically it is currencies, but we are converting them into the interest rates. Company X, if you see the first row, it is Japanese is 5, US dollars is 9.6, company Y is 6.5 in Japanese and 10% in US dollars. So, if you compare them, company Y is facing disadvantage of 1.5 in the Japanese yen and is facing a disadvantage of 0.4 in the US dollar. So, obviously, it makes sense for company Y, if it is case it is yielding in only Japanese yen, it will convert to a US dollars case. So, design a swap that will net the bank acting as an intermediary 50 basis points. So, now here is the information given. That means, once you have the overall transaction, company X, company Y and the FI. So, obviously, there are arrows going out, coming in, going out, coming in, going out, third party going out, third party, this is X, this is Y. So, what it says, once you find out the overall transaction FIs plus minus everything, the overall percentage of profit which the FIs would be making is 50 basis point. That is the end crux result. So, basically once you draw the diagram, inflow outflow diagram, you should basically concentrate on only the inflow and outflow diagram for the FIs, and based on that you will find out that it is 50 basis points and then calculate it backwards to find out what is the basic equilibrium equation based on which you can find out the inflow and outflow diagram. Companies A and B, so this is a new problem. Companies A and B have been offered the following rates per annum on a US dollars 20 million 5-year bond. Company A has, concentrate on the first row, it's 12% fixed rate, LIBOR plus 0.1 in the floating. Company B is 13.4 in the fixed, LIBOR plus 0.6. If you compare the difference, company B is facing an extra interest rate of 1.4 in the fixed and basically facing an extra interest rate of 0.5% on the floating rate. So, obviously, it means that company B would like to change its position from a fixed to a floating, hence company A would change its position from a floating to a fixed. So, it basically means company A requires a floating interest bond, while company requires a fixed interest bond, design a swap that will net the bank. Again, when we come to the financial institution, it would mean the overall profit the bank would make is 0.1% per annum, such that it will be equally divided by both the parties, such that A would pay the extra amount of 0.05% to the financial institution and B would pay the same amount of 0.05% to the financial institution. So, in this way you will basically have the swap, such that if this is A, this is the FI, this is B. So, this outflow, inflow, outflow, inflow. If you find out this total thing, this value would come out to be 0.1% per annum, and this is equally divided between both the parties. Now, we will consider the properties of the stock option prices. So, we will cover these following things: the factors affecting the prices, how we can find out the put call parity, and how we will find out the call and put on a non-dividend paying stock. So, this would be much of a conceptual chapter, and if somebody wants to refer, definitely all the information is there in John C. Hall. So, but we will give a flavor of this corresponding to the fact that we have already understood and dealt with the concept of, say for example, what is an option, what is a put option, what is a call option, what is a long put, then short put, long call, short call, what are the different forwards, and also based on the fact that the interest rates which are there are either the futures interest rate, the zero interest rate or the par yield. So, we will only concentrate for the calculations on the zeroth interest rate and the forward rate, that will become evident as we proceed with our calculation and understanding. So, we would not go into detailed calculation, we will give you a much more conceptual framework how this concept basically can be learned, such that we can understand how the put call parity and all this concept can be dealt in only problems as we consider. So, the factors affecting the option prices are current stock price, for which the symbol is S with the suffix 0 or O, basically means the price of today. Strike price is basically X or T, which you are already considered. For the forward and the futures, if you remember the graph this or the graph this, the value which you had was basically X or K, or say for example, you have a option this. So, the price at which the person would basically exercise the option, that is basically the strike price or the delivery price. So, time to expiration we will consider that is T, this is X and K as mentioned. Time to expiration is T, which is basically the European call, volatility of the stock price. So, let us pause here for 1 minute. By the word volatility, we will still stick to the standard deviation, but this volatility is not for stock price, remember that this is nothing to do with this. So, you should never consider this, because actually what we will be considering is the standard deviation, the rate of change of the spot price, because if you draw the spot price differences, the actual graph would be like this. So, what we are interested in the standard deviation of the rate of change of the spot price. We will also consider the risk free interest rate, which in a problem or portfolio analysis was RF, but with the caveat or an important note that risk free lending rate RFL and risk free borrowing rate both would be the same, because we will consider that if you go to the bank and borrow money, if you go to the bank and lend money, the interest rate would be the same for both the cases, even though that is not true. We will also consider dividends if we are expected during the life of the options are initially 0, that means there would be no coupons and hence there would be no dividends being paid, but later on we will relax the assumption and consider that dividends are being paid at some intermittent payments, such that we are able to find out the dividend payment at time t is equal to 0, that is the present value, And later on we can also relax and find out what is the dividend paying yield, such that continuous dividend would be considered, as we do the case for considering the continuous risk free interest rate. So, if you remember the problems we considered for finding out the futures and forward prices, we considered two values. One was R, which was the risk free interest rate, this is the one. Another concept we considered was the Q, which was the dividend yield continuously compounded. So, we will bring that into the picture also. So, generally if you refer John C. Hull, you will understand that if you have these two different calls, one is call put, call option and the put option for the American one, call and the put option for the European one. So, the European we know that the expiration date is capital time T, for American you can basically exercise it much before. So, if you consider the stock price, it will be considered if in general the European call and put has positive relationship with the stock price and American call and put has a negative price. Strike price, which is X or K, basically would have negative for the European call and American call, would have a positive effect on the European put and the American put. Time to expiration for the European call and European put we do not know, because that is not immaterial, because that would basically depend on whenever it expires, that is the time frame which is fixed. And for the American call and American put, obviously it will depend and when you are trying to exercise it, and the time to expiration would be much before than the capital time T. Volatility, as I mentioned, sigma is always positive for whichever case you are considering, American put, American call, European put, European call. Risk free interest rate is in this case for the put, it will basically be negative for the negative relationship, and for the call it will be positive, we will see that later on. And for the dividends, it will be positive for the put positions and negative for the call positions. The reason for the dividends or the risk free rate, why they are negative positive, as we continue discussing this, I will try to explain it in more qualitative terms, such that you will understand that what is the intrinsic difference between the positions of a put and a call. Leave aside who is buying and selling, that is not important. What is important is that if you go for a call or if you go for a put, the situations should be considered in such a way that you should basically consider when the actual transaction will take place. If I am going for a call position, it means what? I am going to call some product or call some financial instrument later on. So, obviously, I need to go for a, if I am going for a call later on, I will basically go for a put now. So, on the case when I am going for a put later on, then obviously I will go for a call now. So, that means long and short go hand in hand in such a way that if I am selling later on, I will buy now, and if I am basically buying now, I will basically sell later on in order to basically make the position clear such that the overall cycle continues. Or say for example, if I am going to buy later on, I will sell now, and if I am basically going to sell later on, I will basically buy now. Based on that, you will basically have the put and call in such a case that the dividends, the risk free interest rate, the volatility, the time to expiry, the strike price and the stock price would basically have a positive or a negative effect on whether it is an American put or a European put or an American call and a European call. So, few important assumptions for the option pricing as we consider is that there is no transaction cost. So, whenever two parties are transacting between themselves, there is no brokerage cost, we would not consider that in our picture. All trading profits are subject to the same tax rate. So, obviously, there are no discounts or there are no higher or lower interest rate based on which it will be calculated, or there are no higher and lower tax rate based on it overall calculation will be done. We will also consider, as I had been mentioning time and again in different discussions during the course teaching, is that the borrowing and lending rate, which is the risk free interest rate which you have, is basically the same. That means, whenever you go and borrow money or whether you go and lend money, the interest rate RF would always be the same. So, for you important notations which are current stock price will be denoted by S with a suffix 0 depending on when the stock price is, what price is basically being calculated. So, obviously, if you go to the second bullet point, is S is the stock price and suffix T is basically at that point of time when you are trying to find out the actual spot of the stock. X or K, whichever symbol you use, is the strike price for an option. T is the time to expiration for the option for the European call, and obviously for the American call it will be much before. R with the suffix F or R only R is the risk free interest rate which you are utilizing for our calculation. And these four symbols, capital C, capital P, small p are the actual call put prices. Only thing is that we are using the symbols of capital PC and capital P for the American one, and we are using the small c and the small p for the European one. That is point number 1. Point number 2, also remember C is being used for the case for a call option and P is being utilized for the case of a put option. So, obviously, the capitals are being used, again I am saying, for the American one, small symbols are being used for the European one, C is being used for the call one and P is being utilized for the put one. But obviously, you can use the same symbol later on also, like C would always be the call, P would always be the put, small one, and you can basically have this call price and the put price depending on the buyer and the seller. You can basically use different type of subscripts depending on how you want to basically notify those symbols in the problem. But we will still stick to the variables of capital C, capital P, small c and small p as just discussed in this slide. Now consider the upper and the lower bounds. So, consider that capital C or small c is less than equal to S0. So, what it means that if I am going for a call position and I am buying now, then the price should be such that in the case if the price starts increasing, that means S is greater, then obviously I have to take action in such a way that any positive or negative movement in the price would definitely mean that I am not willing to go for a short or a long position depending on the put or the call. Is simply like this. Like consider the situation is this is time t is equal to 0, this is time t is equal to capital T. So, if I am going for a call position, it means that call means I am going to call a product later on at time t is equal to capital T. If I call that product, which means that obviously I would have shorted that actual one now. So, if I short now and call later on, I am selling now and again buying it later on. So, hence if the price fluctuation is such that there is a difference between call and the short position for the same product, obviously that will basically be disadvantage for the player who is basically going for a call and a short position. Similarly, if I am basically going for a put position, if I am going for a buy position later on, so obviously I have to sell. So, if the sell and the buys are not matching each other in the quantum terms, then obviously they would do a huge amount of loss in the two transactions. So, similarly, if we consider the delivery price x or k, then the small price of p, which is the put option, whether for the American or the European one, should be such that there should not be any mismatch. And how these things are done, I will explain that in the subsequent slides later on. So, now let us go one by one and basically understand the lower bound for the European call. Remember, in the European call, obviously the prices are such that you can only exercise when the time to expiry comes. Now, this is, remember, second important point is they are for non-dividend paying stocks. Now, the lower bound is always S0 minus x e to the power minus RT. So, let us consider these term separately. The first value is S0. So, what is S0? S0 is the price of the spot as of now. So, now F0 is the price of the stock or the spot as of now. So, obviously, I have decided on a price which is x for the transaction to happen t time frame down the frame. So, if this is t is equal to 0, this x is equal to at this point of time. So, what I am trying to do is that x price I am trying to convert to a present price. How do I do that? I basically multiply x into e to the power RT, where R is the risk free interest rate, t is the time. So, if the difference between them is positive or negative, obviously somebody may make a loss or somebody will make a profit. But why it is a lower bound? Because in any case, if this calls for the European ones, this is not the lower bound, it would mean that there may be prices which would be higher than this. So, that means lower bound is you cannot basically go below this. So, if the prices are below this, obviously it would mean that the calls would now basically have a different position such that the overall profit now basically changes. That means from a profit it will become a loss, and from a loss it will become a profit, such that it will make sense to change your position in order to basically make extraordinary profit. So, let us consider an example for this. So, let us go through the bullet points which are stated. Portfolio following a portfolio A, which has one European call option plus an amount of x e to the power minus RT is in cash, which at time t would be worth what? So, let us see. Now, I have only one European call, that means I am going to call means I am going to buy it back. At what time? At time t is equal to capital T. The cash which also I have is x into the e to the power RT. So, if I am going to buy back, what I will do with the cash I already in hand, I immediately go to the bank, deposit that cash. What is the amount of money which I deposit in the cash? It is x into e to the power minus RT. So, if I deposit x into e to the power minus RT into the bank, the total amount will increase. What is the rate of change of that amount will increase? It would be now x into e to the power minus RT into e to the power RT. So, the overall value now becomes x. So, once it is x, then what I will do? I will immediately with that amount of money I will go to the bank, withdraw the money of x and immediately go to the option and buy it. That means, because I have gone into call position, which means the amount of cash which I has is exactly compensated by its rate of change of the interest rate which increase, which is x, and with this x amount I basically buy back that particular call option which is there already signed by me. Now, consider the portfolio B has one share which at time t is worth ST. So, if now we have another share which is price ST means actually there is the price. So, now if I consider the price of the particular stock and if ST is less than X and I am trying to call it, what I will do is that I would not exercise that. So, if I do not exercise that, it will mean basically I will go into the market, buy it and buy it of ST. Because if I had gone for and gone for that buying that particular asset at a price of x, if x was greater than basically xt, then obviously I will make a loss. That means from the point of view of the buyer. If it is other way around, obviously I would exercise that and basically able to buy it at a price of x and immediately sell into the market at the price of st. So, hence the overall price of C would be the difference between, as of now, S0 is the spot price, x e to the power minus RT is basically the delivery price as of now, the difference of that, and 0 whichever is basically greater. Hence, my value of C should be greater than that, because if it is not, then obviously it means the seller who is going to the market is going to make a loss. So, obviously, in order to compensate that, the exact price should be equal. So, in the case if it is equal, no party basically makes a loss, no party makes a gain. Now, consider the lower bound for the European put options. So, obviously, change the scenario. So, if you are put, that means you are putting in order to sell. So, again consider the same scenario, but in the other way around. Here you have a portfolio C with an European put option plus one share. So, now the share value would increase. What you will do is that one expires, you sell it in the market. So, if you consider the overall scenario, initially if it was a call, then it was S0 minus x e to the power RT. Now, it is a put, you basically put a minus sign in front of them, you get this based on the maximum value, you will exercise that. So, the value of P in the case of the put option should be greater than or equal to max of x e to the power minus RT minus S0 or 0, whichever is higher, you basically have that value of P, or else you will not have that value of P, it is 0. And in the case when you have basically the call option, it is basically max between the difference. Now, it is just the reverse. So, the moment the prices is more than any 0 value, obviously that is the value of the call option. So, with these two slides, I would urge the students to basically go through the slides and also try to go through the John Searle, and based on this we will continue the next class of discussion. Thank you very much.